This segment is sponsored by Esperanza Resources, an emerging gold and silver producer with 2 advanced stage projects and a $50 million cash position after selling a property to Silver Standard. And Esperanza Resources is one of the companies that Rick Rule said would be taken over in the coming consolidation phase in the mining sector. Esperanza Resources, symbol EPZ in Canada and ESPZF in the U.S. This is King World News. I'm Eric King, and you're about to hear from a legend in the business, Felix Zulauf. Remember to go to our homepage, kingworldnews.com, for more interviews where we've already had Rob Arnott, Michael Pinto, James Dines, and Mark Faber, and where we will have a special Sunday release with Egon von Greyerz. But without any further delay, here is Felix Zulauf. Joining us now is world-renowned money manager Felix Zulauf, who has been a Barron's Roundtable panelist for over 20 years. Felix, I wanted to ask you right away, in your Barron's Roundtable interview, you were speaking about the dangers of derivatives and the danger they pose to the system. Can you elaborate on that?
Well, the derivatives are of such magnitude and they are not transparent that we are not aware of that risk. Obviously, there are several hundred trillions of contracts, notional contract amounts outstanding in the global banking system and the shadow banking system, and nobody really knows exactly who holds what contract. I remember the days when Buffett went into a company, I think it was Salomon Brothers or Goldman Sachs at the time, and said he didn't understand it. And when he doesn't understand it for one company, how does anyone understand it for the whole system? And this can have a leverage effect when things go really wrong, and therefore this is just an additional risk most people are not aware of.
In the Barron's interview, you also said, quote, the potential exists for a broad-based nationalization of the credit system, capital controls, and dramatic restrictions on financial markets. Some might even be closed for some time, end quote. And I know it's been years, but we've spoken about your statement. People needed to be outside of the banking system going forward. And I think that frightened people a little bit at the time, as you can imagine, but they're very scared today because they're seeing people in some pockets around the world losing their assets, being inside the financial system, or portions of their assets. We had MF Global, and we've had some other things happen.
Well, the global banking system, particularly in the industrialized world, is still highly undercapitalized, and that's the big problem. And it's a little bit better in the U.S. than in Europe, but it's still very undercapitalized. So if anything goes wrong, bank balance sheets are highly leveraged, and you have a problem. The problem I refer to was at the time when the central banks were running behind the curve. I think over the last couple of months, central banks have woken up and they see the risks, and particularly the move by the ECB here in Europe means that they are all in now. That means they will finance whatever it takes to not let the system go down. And this, for the short term, gives you some assurance. For the long term, it's a different story because there is a cost associated with this. And the cost is that the fiat currency or paper currency standard is in the final stage of the supercycle. Fiat currency systems always collapse at the end, and we are in that stage of the supercycle where things are accelerating. And I don't know how many years we still have, but you can assume that central banks will, as the ECB stated just recently, will do everything necessary to prevent a collapse of the system. That means they will finance even bankrupt governments, they will finance bankrupt banks, they will finance every bankrupt entity that is important to the system. And that means they debase our paper currencies further and further and in an accelerating way. This is very bullish news for all the gold holders, of course.
Well, then let's talk about gold. Going forward, what do you see happening in gold, and how about what it's been doing recently?
A good year ago or so, gold had accelerated into a sort of a climax peak above $1,900, and then it has taken almost a year to correct that sharp advance. And I think gold has absorbed the selling pressure very well and has gone through a lengthy cyclical corrective process and into the low 1500s. And there was always a risk that it could break down once more to make for a climax low. But I don't think this is most likely anymore. I think the odds for that happening have decreased. The recent change at the ECB, that they are all in, is a big plus for gold because it's a big negative for paper currencies, and gold is just the other side. So while gold has run up into the 1700s, we could anytime see a certain setback of 50, 60 bucks or so. That would be normal. But from now on, buying the dips is the right strategy because I think we have entered actually the next cyclical bull market within the secular bull run that we are still in. And I think this has much higher highs to go. And I do not know how long it will go and how high it will go, but it is just the juxtaposed asset to the paper currencies that lose value.
Felix, I want to circle back around to what we were just talking about a moment ago about being outside of the banking system. As I said, people are very fearful now about a system collapse. And I want to ask you, if people own shares of high-quality companies, but they are inside the banking system at major brokerage houses, do they have to worry about their assets and losing their assets in that situation?
Actually, based on the law, as I understand it, at least in Europe, when you have shares in custody with your own account with a bank or broker of high reputation, that should be safe. I'm not fully aware of all the details, what went wrong with MF Global and things like that. In gold, it's a different story. You cannot store gold in custody that way because that's a different way. You have to have physical deposits. And, of course, you can put it in your own safe, you can put it into a bank safe, but when there's a bank holiday, you cannot touch it, of course. So there are ways outside the banking system where you can store your gold. There are a few companies offering that service. There's also one in Europe I'm working with. So there are ways to store your gold outside the banking system, where it is available, where it is insured, whether it is guarded. And even some central banks are holding some of their gold in those places.
Felix, you mentioned the system being at risk of collapsing in longer term, the fiat paper system collapsing as it always has historically. Can you talk about that and how that will unfold?
Oh, that's a difficult one because I cannot really tell you when it occurs. But usually in a super cycle, you have to debase your currency more and more. You monetize your debt more and more. Your level of debt on a public sector basis and on a system-wide basis goes higher and higher until the system collapses. And I think we first see over the next couple of years, we will see the transfer of government debt from private balance sheets to central bank balance sheets. I do believe that the 30-year bull market in government bonds is over. I mentioned in the media roundtable that one should be selling half of what he owns and should sell the other half in September the latest, and here we are. So I think the whole game is over. Bonds are very overvalued. The real return is negative. Normally, bonds yield at least as much as nominal GDP growth. Nominal GDP growth at the present time is about 3 or 4% or so in the U.S. I'm not suggesting we go right there tomorrow, but bonds are very overvalued, and the world has gone for bonds, and in the recent years, nobody believed it. I have stayed bullish, but it's over. The game is over, and we have to look for other assets.
Felix, in this environment, then, what should people be doing with their money? How should they be playing it here?
If you have a later stage of the fiat currency system where you debase your currency in an accelerated way, and this is really true for all the major currencies in the world, Then, of course, you have to move out of nominal assets and you have to move into real assets. Real assets are real estate, and the real estate markets differ from country to country, from region to region, from location to location. But in general, I would hold some real estate, and I think in the U.S., the real estate market has corrected about as much to say now that the valuation relative to income levels, et cetera, is fine. I'm not saying we are going up right from here straight ahead, but I think the downside is so low that it is good value, particularly when you compare it to other places. There are a few places in Europe where real estate is still priced in a way where you can buy it and store some of your wealth. So I would say you hold 1/4 in real estate, you hold 1/4 in gold, we talked about, because that's a very safe place to be over coming years, and then you hold another 1/4 in equities. I'm not saying just now go out and put all your cash into equities, but I think over the next few years there will be periods when markets will shake out and decline. So I think over the next 2 years or so we will probably see 1,000 in the S&P again, something on that order. And when that occurs, that's an opportunity to buy more stocks, or if you don't own any, to buy stocks. And I would buy multinational companies with solid businesses that can even withstand severe crisis and that have solid balance sheets. And they operate around the world and also to a large degree in emerging countries. And the final 1/4 I would hold in cash, because whenever there are opportunities, I would step in and buy it. If you don't have cash, the best opportunity is an opportunity gone by.
Also from your Barron's Roundtable, quote, "We are witnessing the biggest financial market manipulation of all time. The authorities have intervened more and more and thereby created this monster. They might change the rules when the game goes against their own interests," end quote. Can you elaborate on that?
Obviously, policymakers are completely lost in this environment, and therefore, when the market forces are such that it jeopardizes the system and they dislike it, then they change the rules. For instance, if interest rates of government paper shoots up, like it was the case for Spain or Italy or so, then the central bank comes in and provides the money and buys whatever it takes to move the interest rate to levels it likes. And when you do that again and again, you distrust the invisible hand of Adam Smith, so to speak, and you trust the hand of the nomenclatura, so the political class in central banks and in governments. And, I really doubt that bureaucrats know better than the markets how to allocate money and assets in our world. Once they start doing that, and they do it more and more and more, there are going to be, and there already are, misallocations of major proportions and not to the benefit for our system. So that's how they create a bigger and bigger growing monster.
But Felix, you said we should expect capital controls, these restrictions on financial markets, and some even being closed for some time. That's the vision you have going forward.
Yes, I think shorter term that risk has decreased a little bit with the ECB being all in now, but it will come again. Because whenever you start manipulating, obviously a currency can go down or up more than the government likes or dislikes. Then they come in and try to move it to the level they like it. You saw Switzerland. Switzerland has relatively sound fundamentals as an economy with chronic current account surplus, low inflation rates, and a strong currency. And the same goes for countries like Singapore or Norway or so. And whenever capital flees other currencies like the euro or the US dollar or a British pound or whatever, and they flow into those currencies, obviously the currency gets to such an overvaluated level that it crunches that economy. And it would create a severe recession and structural adjustment with very high unemployment, etc., etc. Then, of course, the authorities come in. The Swiss central bank has come in, and they said 120 to the euro is the level we accept and not more than that. That's it. As a result of that, their foreign exchange reserves are shooting up 50 billion every month to stabilize the currency situation. Now, Switzerland is obviously a small country and doesn't really and isn't really important to the world, but other countries may do the same thing on a much bigger scale in years to come. And this will lead to huge misallocation of capital. And by doing that, you create the governments and the central banks as the biggest market forces in the financial markets. By that, it means that the free market forces of supply and demand, as it should be in a free market system, are offset or overrun by bureaucrats setting price levels the way they want. For instance, the interest rate of the capital markets is the most important information a capitalist system has. For years now, we have authorities setting interest rates in a way they like it and not in a way the market would do it. And by doing that, they are sending signals to all the market participants in our economies what the price is. And maybe this price is wrong. And based on this price of money, you have all sorts of misallocations. That's how the big housing boom in the U.S. started and happened. And some other bubbles, like in Spain, etc., the same thing. That's the problem. They should let market forces run alone and not intervene, or only intervene in extreme cases, and after interventions and the return of normal conditions, get rid of what they have intervened. But the way they are doing it is different. You can also say the government believes that an economy must grow at X percent. For instance, the U.S. would like to see its economy growing 3%. Well, who wouldn't? But because it doesn't grow at 3%, it comes in a recession with all sorts of support. And by supporting the system, the government goes into huge deficit. And we are now at the chronic deficit of 9%. If, for instance, we had another accident like in 07 or 08 or 09, and they wanted to achieve the same result with fiscal policy as they had then for the turnaround, they had to increase the current deficit from 9% to 16%. And, once you go into this, it grows bigger and bigger and bigger, and it gets more and more excessive. The result is like in the last 4 years of the current administration, and it's not just Obama's fault, believe me. U.S. government debt went from 10 trillion to 16 trillion in just 4 years. And if we do not get rid of that insane policy, we will end up with much, much bigger debt levels and debt levels that are not financeable anymore. And then, obviously, the private capital markets will say, enough is enough. We don't invest in that paper because the interest rate is too low and the risk is too high. And then interest rates go up. And, of course, the central bank can intervene, and at the end, the central bank will be the biggest owner of government paper. But if you have that situation, then the currency is not worth much anymore.
And Felix, I know here in the U.S. you do advise a hedge fund here. What's the name of that firm, and how can people get involved in that?
Yeah, among several clients I advise, it is in California, 300 North Capital, a hedge fund run by Rick Campagna, a colleague of mine. I'm not the manager. He's the manager, and he does a superb job. He's up about 16 or 17% again this year.
World-renowned money manager Felix Zulauf, Barron's Roundtable panelist for over 20 years. Thank you for joining us on King World News.
My pleasure, Eric. Thank you for having me.
Be sure to tune in on Sunday as KWM will have a special release with Egon von Greyerz covering the gold market and more. And be sure to tune in each day as we will continue to release interviews with the top people in the world throughout the week. Also, make sure to check out the King World News blog.